What are the tax implications of company cars? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Company cars. Should you get one or not? Now, this is a question I get asked all the time. So let's have a look at what the different consequences are of having a company car, as it can be a really great opportunity or it can be very costly. So there are two different things we need to talk about. We need to talk about a normal car, a petrol diesel car or a hybrid, and we need to talk about electric cars. So I'm going to start with the normal cars, as that's what a lot of people are still getting, but we'll go on to the electric cars, which are a little more interesting and definitely have a little more scope for things. So you've decided to buy a normal car. So I'm not even going to go with what car because it's not my area of expertise. But we've bought a car and let's say we've paid 10,000 second hand for it. Now, that will become an asset of the business. So that 10,000 we will put as a fixed asset onto our balance sheet and we'll put that as an asset in the business. Now, if you've paid any VAT, unfortunately, it is not claimable. Now, obviously for a lot of property businesses, VAT is irrelevant, but for the odd type of business, if you're sourcing or commercial, you may be VAT registered. But unfortunately, in this scenario, you're not going to be able to claim the VAT back. Now, the next thing that we want to move on to is the capital allowances side of things, which check out the video on capital allowances to find out more about what they are. But in effect, for a fixed asset, which is a business car, you can't claim something called the annual investment allowance and you can't claim first year allowances. So if you're not sure what they are, check out the videos on annual investment allowance and capital allowances, but you cannot claim them. What you can claim on a business car is something called the writing down allowance, which is at 18%. So you're not going to be able to claim that whole 10,000 today on your tax return, but you can claim 18% of that each year progressively over the years until it is not worth anything. So it's better than nothing. Now, let's move on to how it affects you and the company from an employee point of view, as this is where it's a bit of a kick in the teeth depending on the car you're looking at purchasing. And the key phrase here is a benefit in kind. Having a business car, which you're using for both personal and private use, personal and business use, should I say, when you're using it for both, that means you've got a benefit in kind. So you have a car that you can use privately, so you've got a benefit from the company, which means you've got to do something called a P11D form, which is basically the benefits in kind form. Now, how the calculation is done for this benefit is it looks at the value of the car. Now, unfortunately, you may only have paid £10,000 for this car, but for the benefits in kind form, what it actually looks at is the original list value of this car. So I could have paid 10,000 for it, but the list price could have originally been 60,000. So I'm not going to use the 10,000 I pay. I am going to use 60,000 as my list price when I'm doing my calculations. Now, you might think, what does that matter? Well, this has a big effect on the value of the benefit that you're going to be claiming, because the benefit is a percentage based on the CO2 emissions. So the higher the CO2 emissions, the higher the percentage I am going to be using. Now, these percentages for your P11D start at 25% and they go up from there. So if I've now got a 60,000 car and I'm now paying 25% is my benefit, the benefit on that car is now 15,000. So I've paid 10,000 for this car, but my benefit is now more than the value of the car that I've just purchased. And that is not for 1 year, that's for every year that you have that. Now, what do I mean by this benefit? So what will happen now with that 15,000? That will go onto your P11D, and that will be provided to by the company to you as an employee. Now, you as an employee will potentially do a tax return for other things depending how it all fits together. if that's the case, on your tax return, you'll have to put this value of 15,000 onto it with your other things like maybe your salary, dividends, rental income. This benefit will also go on there. So you might be paying quite high rates of tax depending how that fits together. If you're a basic rate taxpayer, you'll be paying 20% on the 15,000. If you're a higher rate taxpayer, you'll be paying 40% on that 15,000. So it can have quite a few implications. Now, that's you as an individual. Now, what about the company? Because the company doesn't get off scot-free here. As an employer providing a benefit to an employee, an officer of the company, they will also pay some tax. And what they will pay is they're going to pay Class 1A National Insurance. Now, the Class 1A National Insurance is around the 13, 14, 15% rate. So on that 15,000, the company is now going to have to pay that percentage of that 15,000 as well as a tax charge under Class 1A National Insurance, which is the national insurance taxes. So you're now paying tax on the 15, the company is now paying tax on the 15. So as you can see, it starts to add up. Now, on that 25%, that's just the starting rate. So if your car is highly carbon dioxide bad and it's got a lot of CO2 emissions that it's kicking out into the world, then the tax charge gets even higher. The other thing to mention is if you go for a diesel car, the lowest rate that you'll pay is not 25%, it's 28%. Because for any diesel car, you look at the CO2 emissions, and if it's diesel, you add an extra 3% on to that rate as well. So as you can see, there's quite a few tax implications here that it could start adding up and getting quite costly depending how things fit together. For the right vehicles, it can work amazingly, and depending on your tax position, there is definitely options. For one-man companies, or two man and woman companies, or one-woman companies, generally it might not be the right choice. As your business grows and develops, it may be something you want to look at doing. Now let's move on to electric cars. And the reason electric cars get a little more interesting is because, well, basically with the climate change issues within the world, we are moving more towards electric. So the government's actually done a few different things to try and encourage us to move towards electric cars. So actually, electric cars suddenly become an option. Now, for the cars we've just talked about, I've talked about getting second-hand. No, it doesn't really matter which you decide to go down or how you decide to finance it. The tax position is still going to be the same. However, for electric cars, it's slightly different. And if you buy a new electric car, there is a lot of tax benefits to actually having one of these cars. So, what does it mean and how does it work? So for an electric car, as we said, there's no changes in the VAT position. You're not going to be able to claim the VAT back. However, when it comes to capital allowances, we actually fall within the rules of the first year allowances. And what a first year allowance does, it means if I spend 50,000 on my new electric car, I can now claim the first year allowance, which means I can claim 50,000 against my corporation tax, which means if I'm paying 50,000, I've got 50,000 profits, I can now put my company car against that to mean I've got no profits to pay me tax on. So it's just going to significantly reduce your tax bill by whatever rate you are paying. So all of a sudden, I've just reduced my tax quite noticeably by buying that car. Now let's move on to the other area, which is the benefits in kind side of things, because that could be the killer for some people. But for an electric car, the rates are very low. Now, a number of years ago, they were at 0% because they were really trying to encourage us. Whereas now, they're at about 2%. So let's just look at that in comparison to a normal car. We've got 25% and we've got 2%. So I buy a car for 50,000. I'm now 2% of that, not 25% of that. So that's probably, what, a couple of hundreds? £1,000 that my benefit is. So that's quite a significant difference. So can you put £1,000 benefit? For quite a few people, that might not be a problem. and £1,000 national insurance charge for Class 1A. Again, it's not as big a hit to the company. So it really opens things up. The key thing here is it is a new electric car, so you can't be going and getting second-hand different ones. It needs to be you're the first registered owner. So you do have to get a new one. So the cost of doing this is that little bit more. But the tax benefits are actually quite significantly positive in some ways because the tax charge is very low. So capital allowances, you'd be able to claim the first year allowance on the whole of the amount that you paid for the car. The benefits in kind are starting at present in the 22-23 tax year at 2%. So the benefit will be £1,000. So if you're paying 20% tax, you're going to be paying tax £200 income tax on that, or £400 on the higher rate. So again, some of these figures, they're not big numbers, which makes it a real possibility. And then the other side of things is for the company, yes, it's going to have to pay this Class 1 national insurance, but for £1,000 benefit at 14, 13, 14, 15%, again, it's not big numbers. So you may want to have a look into electric cars if they may work for you. Now, the things that I am aware of with electric cars, it is that charging point that you need to make sure you've got the appropriate charging point in. If you're doing long journeys, you just need to plan them a bit better to make sure if you do need to charge the car, you've got the timings right, you have the right brakes, because you don't want to be breaking down in your electric car because you've run out of electricity. So there's a few caveats that you may just want to make sure is going to work for you, but from a tax point of view, there's definitely pros compared to just any old car. So hopefully that gives you a bit of a summary about how it works with general cars, how it works for electric cars, and they are pretty much the same. It's just there's different tax implications at the moment because of the encouragement of doing things with electric cars. So the key thing is no VAT can be claimed. There are capital allowances available, whether it be the writing down allowances or the first year allowances, and you will need to do a P11D benefit in kind form, and you will have something to report as a benefit, and the company will have Class 1A national insurance to pay. Have a look what your car that you may want is going to be costing you, and do speak to the dealers. They are very up on this because they want people to buy cars, so they will tell you all the different figures to be able to do your calculations to see if it is worthwhile you getting a company car. Hopefully today you've discovered what it means to have a company car and the tax consequences and implications of having one. If you do have any questions, then please do leave a comment. Please like the video and do subscribe to the channel, and let's make tax less taxing.